All right, let's dive into a really fascinating one today. We're talking about Premier Inc., ticker PINC. They just reported a blockbuster quarter, but the stock's reaction, well, it was a total roller coaster. It's a great story about numbers, narrative, and a market that took a few hours to figure out which one really mattered more. So let's get into it.
So this is the big puzzle we're going to solve. Premier posts an adjusted earnings beat of more than 25%. I mean, they blew past what analysts were expecting. And yet, the stock immediately sold off in pre-market trading. So what on earth did the market see that spooked it? And maybe more importantly, what did it finally come around to appreciating?
Okay, first things first, let's just look at the hard data. Because on the surface, these results were just incredibly strong. We're talking pure, unambiguous good news.
I mean, look at this. Premier absolutely crushed expectations. Revenue came in at almost $263 million, which beat the consensus by nearly $16 million. But the real story, the headline, was on the bottom line. Adjusted earnings per share hit 43 cents, just smashing the 34-cent estimate. That is a clean beat on both the top and bottom lines.
Yeah, let's just put a fine point on that. A positive surprise of over 26%. We're not talking about a tiny beat here. In any market, that is a massive, massive outperformance.
So you're probably asking, where did this strength come from? Well, the engine for the beat was their supply chain services segment. Now, even though it was down a bit year over year, it still performed way above what people were thinking, thanks to better contract penetration and new members. Performance services was a little softer, but just hang on, because as we're about to see, there's a powerful turnaround story brewing right there.
And that brings us from the numbers of the past to the story of the future. See, to really get why the market reacted the way it did, you have to understand that Premier is smack in the middle of a major transformation.
The CEO, Mike Elkire, he really framed it perfectly on the earnings call. Premier is trying to tell the world, hey, we are not just a group purchasing organization, a GPO, anymore. The whole focus is shifting to using their data, their advisory services, and their tech to become a much bigger, broader healthcare improvement company.
And you know, this isn't just talk. They're putting their money where their mouth is. They got rid of their S2S Global unit. They just bought a company called IllumiCare to beef up their tech. And they're shutting down their non-core Contigo Health business by the end of the year. Every single one of these moves is about simplifying the business and focusing on what really works.
Okay, remember I told you to keep an eye on that performance services segment? This is why. This is where the story gets really exciting. Inside that segment, the advisory business is gaining what management called meaningful momentum. They've signed 4 huge new deals, they're hiring a bunch of senior people, and get this, they're projecting over 25% growth for fiscal 26. This isn't some side project, it's becoming a real, high-margin growth engine for them.
Okay, so let's recap. We have a huge earnings beat and a really compelling new strategy. So let's go back to our paradox. How in the world did the market process all this in real time?
And this slide just says it all. It was like the market had a split personality. Before the market even opened, the stock plunged almost 6%. Why? It was spooked by weak forward guidance. But then, as the day went on, a totally different story took over. People started to digest the great quarter, the capital return plan, and the strategic cleanup, and bam! The stock did a complete 180, closing up over 7% on huge volume.
And don't think this was just some weird one-day fluke. It's actually part of a bigger pattern. If you zoom out over the past year, PINC is up 31%. Meanwhile, the broader healthcare sector ETF is down over 10%. The market is clearly starting to get the message and reward Premier for this big evolution.
So, what we've got is a strong present, a kind of messy-looking immediate future, and a really promising long-term view. Management is basically asking investors to just look across the valley to fiscal 2027.
Okay, so this is it. This is the guidance that caused that initial pre-market panic. These numbers, right at the midpoint, were just, below what Wall Street was hoping for. This is where all that early negativity came from, and it's why management is being so careful about how they frame the next year.
And this is the most important takeaway for the short term. Fiscal year 2026 is a bridge year. It's all about getting through the last of some contract headwinds and that Contigo wind down. Basically, they're clearing the decks to set up for future growth.
Now here's a huge catalyst that I think a lot of people missed in that initial panic. The company just made its final $100 million payment for something called a tax receivable agreement. Starting right now, that cash is freed up. That's $100 million a year that just poof, drops to the bottom line, dramatically boosting their free cash flow.
And this is the payoff. After they get through this transition year, management is being super explicit. They expect an inflection point, a return to positive growth across the board. Revenue,
EBITDA, and earnings per share in fiscal year 2027.
And look, this isn't just wishful thinking. It's built on a pretty solid foundation. The old GPO headwinds start to fade, software renewals pick up, that advisory business keeps growing like crazy, and they start getting synergies from the IllumiCare deal. You can see a really clear path back to growth.
So let's put it all together. What's the call here? It's time for the next call.
With a much cleaner story taking shape, and these big free cash flow tailwinds just around the corner, the key question becomes, how could an investor actually play this expected rebound out in fiscal 27?
The bull thesis really comes down to these four things. 1. The market still kind of misunderstands the company as a boring old GPO. 2. The business is getting way simpler, which makes it easier to understand and value. 3. The cash flow story is about to inflect in a huge way. And 4. That advisory business is a powerful growth kicker that I think the market is still underappreciating.
So if you buy into that thesis, here's one way you could think about it. We'll call it the wild yet plausible trade. You could look at a long-dated call spread, something like buying the $25 calls and selling the $35 calls that expire way out in 2027. It's a way to make a defined risk bet on not just the earnings growth, but also on the stock getting a higher valuation multiple as this whole transformation story becomes undeniable.
Okay, now to be perfectly clear, this is not financial advice, but let's recap. Premier stock went through a classic paradox. The market sold the news on some weak guidance, then it bought the reality of a massive earnings beat and a big strategic cleanup. Fiscal 26 is definitely a bridge year, but that path to renewed growth in 2027 looks pretty solid. For that reason, our view is market perform for the near term, but outperform on a 12 to 24-month horizon.